How old are your kids?
No kids.
No kids. Oh, okay.
Yeah.
I was just complaining about my kids.
How old are they?
7 and 2.
Oh, they are different.
Oh,
Will,
sometimes we don't know, like, did you come from the same parents? It's like, if you have siblings, it's like my sister and I are very different, and like it's like wow, literally completely different. Oh,
let's kick it off.
let's
All
do
right.
it.
Cool. Thanks again for joining, guys. We'll follow up with you after. Hello, everyone. Let's get into another Sydecar session. So topic today is how emerging managers can maximize returns by harnessing SPVs. So we're going to talk from the emerging manager perspective, how you can leverage SPVs, LP perspective, thinking about how they're thinking about it, enhancing returns through co-investments, and then just generally looking at best practices and trends that we're seeing, and also tagging in some of our friends in the industry. So I'll go ahead and introduce our two exceptional panelists that we have today. We're excited about having them. So first, Sydney Bai, a trailblazer in venture investing since 2011. Cindy, you have 14 unicorns to your name, I see here. You operate as the solo GP at CapitalX. Cindy's keen eye for potential has attracted support from industry giants, led to the success of companies like SlopePay and Snaptrude. Cindy is a master at leveraging strategic investments to fuel growth. So excited to hear from her in a minute. And joining Cindy is Shen, a seasoned entrepreneur, investor, and lawyer with deep roots in the US and Asia. Chris's work spans venture capital, data analytics, and portfolio management, with a special focus on cross-border investments. He's also currently the CEO at Revere, a partner of Sidecars. At Revere, Chris is revolutionizing how asset allocators manage their alternatives portfolio, and they've built a powerful combination of automation and AI to help support them. So bringing everyone together today with this experience and insight to talk about the dynamic world of SPVs. Let's get into it. First question, actually, first topic or subtopic, I want to talk about track record. So one thing we see a lot in the emerging manager world is this idea of using SPVs as you're building a track record, maybe before a fund or alongside an early fund. And so, Cindy, if I could start with you and ask you to tell us a little bit about how you thought about it initially, deploying SPVs versus a fund, and how you think about it now with where you're at now, that idea between, SPV or fund or both.
Sure. So I started investing kind of like angel. I did it on the side. So I only started my fund in 2020. So for that, I'm still emerging manager. In 2020, it was easy to raise fund. So I had rolling funds. And I had a lot of great LPs, people I didn't know. My fund was focused, that is focused on early stage, pre-seed and the seed round, maybe sometimes Series A for my portfolio pro rata. However, I have deal flow of later stage of a lot of amazing founders like Series B, C, or even unicorn round. But in order to, really join the journey with all these amazing people, I wanna invest, but my fund is early, so SPV was very natural for me to do, and also I started in 2020, 2021. Again, the time was super good. For the later stage SPVs, it was not hard to raise $1 million, $2 million each. So the difference between funds and SPVs, for me, I never charge the management fee for the SPVs. So it's not ongoing income. However, the carry was substantial, and I can do both early stage with the fund and the later stage with SPV because of my, my network, my deal flow, how many founders I want to, work together with. So it was natural. But since 2022 and 2023, as the environment became harder, I started doing fewer because it's very time consuming. For new managers, there are a few advantages or good things that you can learn from doing SPVs. Write a memo, right? You have to be so convincing. So individual LPs, small check writers can join you without talking to you, because most of the SPVs, we don't host a meeting. It's just by what you read, what we write. So you definitely enhance your skills of writing memos and telling stories for the founders, and also increasing your network of investors who may decide to invest in your fund later. I can stop there. Later I'll add more.
Yeah, that's great. Thank you for that breakdown. In the interest of using these SPVs and developing this relationship with LPs, showing what kind of access you have, we're hearing more about warehousing. I'm curious, how have you thought about warehousing, either yourself or maybe from some of your peers, in that context of coming into a fund? How do you think about it?
I did that too. I did that even for my rolling funds for the first quarter. I think it's a good sign for LPs to see, first of all, you live in a warehouse. We put the investments in the fund at the cost, right? And usually when we do that, there is already markup. So it is, something the LPs like. Oh, you are kind of, giving up your personal gain to show how genuine or even like you have more skin in the game because you are willing to warehouse. It's basically it's a good gesture, and if I think no LPs will say no to that.
Yeah, that makes sense. Chris, I want to tag you in here on the LP side of things.
Mm-hmm.
How do LPs think about the SPV track record, and how are they thinking about warehousing now, looking at a potential fund that maybe can show some warehouse deals already in the mix?
Great question, Rob, and thanks for the context, Cindy. So I'll divide it up between sort of what we see at Revere and then my past experiences as a family office investor based overseas in Hong Kong. So on the family office side, I think seeing sort of deals and sort of doing the deals is better than not doing deals at all, right? I think there's this sort of thing where an emerging manager comes out and is starting his or her own fund, and they're like, okay, I've got these deals, and it's like, have you done any of these deals, right? It's like, no, it's just a pipeline, right? I think doing smaller checks, sort of running syndicates like Cindy has or rolling funds on different sort of platforms are all good because you want to show that the investor, that LP, that you're doing deals, right? You're diligencing, you're writing memos, you are executing, transacting, and then managing the asset. I think that is important because whether it's a 10K angel check all the way up to a $1 million syndicate or an SPV that you're running, the LP is essentially hiring that emerging manager or that manager to go invest on their behalf, right? That's what the game is about. So doing deals, whether it's an SPV, sort of different formats, et cetera, is better than not doing anything at all, right? At Revere, because what we do is we have the world's largest community of emerging managers, 500 plus. We evaluate them, bring them into our network. We have the collective, which we're working on with Sydecar, into getting sort of the community and sort of the ethos of the emerging manager to LPs around the world. We evaluate emerging managers based on 20 different points. And one of that is firm management, how you're doing LP communications, and how you're investing, right? Everyone wants to make good returns, but when you look at sort of, someone experienced like Cindy, who can show a list of like 15, 20, if not more memos, transactions, et cetera, her fund would sort of outshine and stand out compared to another emerging manager. Say, for instance, if he or she had not done any deals, a few angel investments, and have never managed capital, so to speak, for third parties. So I think when you differentiate between managers, there are certain managers that really stand out because they have done the work and they can show the track record that a proven track record that they did do the work.
Makes sense. That's super insightful. A follow up on that, in this vein of demonstrating and providing this data. Chris, how can managers think about leveraging metrics from maybe those syndicated deals to their advantage, thinking about kind of analytics and how to best communicate that?
I think, it's track record, right? Like, I think if you're giving up paper gains and sort of warehousing deals and sort of all these things, you can talk about these things to an LP, in a sophisticated LP. This is not sort of people that are new to the game, because that's going to require more sort of education. But people that understand sort of how this game is played, to Cindy's point, they will very much appreciate that, right? So that's one. I would say two, data. There's plenty of data out there, I think, in terms of things on PitchBook, Crunchbase. We have our data set about sort of how managers perform. I think if you can take what you've invested track record wise and stack rank against sort of different indices and benchmarks to kind of show the more data driven LP how you rank and how your sort of portfolio looks, that's also really good, right? I think less relevant to this conversation in the hedge fund world, everyone runs a sort of simulated portfolio that they run, and no one's ever had a bad simulated portfolio, right?
Mm-hmm.
I think you'll see more of that data in venture capital, and I think, and I hope more emerging managers will take sort of their portfolio and benchmark that against sort of different indices and show that outperformance and or the things they may have missed out. So that's kind of where data is coming into play.
Yeah, makes sense. Okay, the pivoting a little bit to the co-investment angle here. So in the same vein of using SPVs and thinking about the dynamic between managers and their LPs, Cindy, I want to ask you, what do you think about this concept of co-investments, offering co-investments to your LPs as a value add to the relationship, and maybe follow with some of the details if you've done this, thinking about, like, is there a standard on economics? How do the economics vary from the fund economics?
So I haven't done this, but I've seen other GPs do this, which I think is a great strategy. So sometimes people offer, GPs offer LPs in their fund. When they co-invest in the SPVs, they can offer lower carry. Or a priority to access if it's very hard, a very popular deal. So definitely being an LP in a fund, we want them to feel valued. If they want to invest in our SPVs, we will try our best to make it happen, or give up some carry. Yeah, and when they run SPVs, actually, from my perspective, the hardest is to raise enough. Because not all usually deals are not that hot. If they are that hot, probably it's very, very hard to do SPV. So then it's really about our judgment, our special deal flow, and so we want to let the founders also know, we have the capacity or capability to raise fast enough, so this SPV is not a drag for their fundraising process. So yeah, co-investments LP definitely all LPs appreciated lower carry, priority access, but also to the founders, we want them to think of us. When they say we want to take this much allocation, they can deliver it within a reasonable time frame.
Yeah, that makes sense. Do you think about how do you think about the difference between, hey, we have an outsized allocation, or we can get one, right, that's bigger than the check that we're going to allocate from the fund, versus the other, the one we see, which is we're not going to invest from the fund for whatever reason. It's outside our thesis. And I've heard opinions, right, where that's a much different strategy. Do you have any thoughts about the idea of syndicating deals that you're not investing in from the fund for whatever reason?
Yeah, so my fund is more on the generalist side. So I don't need to defend, what company, which company I invest in because of the sector, or if it's a space, or frontier, or bio. I can invest in whatever based on my fund thesis. But I do understand sometimes when you are let's say enterprise software focused, or consumer focused. But then once in a while, you meet a founder that's so, extraordinary, and you are still so convinced. However, if you have a fund thesis, it really is not good fit. I think you can definitely still do, SPV, as long as you can convince your LPs that, you not investing from the fund is not a signal that you don't think this is good.
Yeah.
As long as you explain it, yeah.
Yeah, that makes sense. Chris, what are you seeing from the LP side around, I guess, first off, the appetite for these co-investment opportunities? And I think maybe fundamentally, we're talking about syndication or going through a structured vehicle versus, maybe what has historically been the case, which is making an intro
Yeah.
and giving them access to direct investments that go outside of any managed structured vehicle.
Yeah, I think Cindy touched upon it. In a perfect world, the GP has filled like 75%, 25% goes to relationship building with that LP, and they can fill it quickly without asking all these questions, right? Or accessing the company, looking at financials, because it's like, I'm not supposed to do that anyway. LP can fund 70, that 100% forms part of the ownership. And one thing we didn't talk about, if Cindy or another emerging manager sets up an affiliate entity, then you can look at it sort of a total ownership, and they can maintain that on the cap table, right? Instead of all these different line items. That's called the perfect world. And we clearly don't live in a perfect world, right? So a lot of times things break down where the LP, like from a personal experience, when I invest in emerging managers, we always ask for pro rata sort of, co-investment rights. Were we going to exercise them? 99% of the time, no, right? But LPs want to feel special. So a lot of LPs will negotiate that. And as a GP, depending on sort of where, your relationship with them or how big of a check they're going to write, you kind of have to play ball, right? It's an emerging manager. Not everyone's Andreessen, Sequoia, Benchmark who can just say, no, we have enough money, no, thank you, right? So within that, after the GP sort of works with the LP to say, okay, we'll show you these deals, then I think the manager has to actually show those deals when they actually come up, right? So that is a balancing act, as both of you mentioned, in terms of making sure that the company is not like, hey, are you holding up the raise? What, I gave you this allocation, can you fill it? To working with the LP, and they're not sort of asking all these questions, et cetera. So in the buyout world, we see a lot of these larger funds that are doing like these second, co-investment funds that take from their main flagship primary business, and they collect all these co-investments and sort of do that vehicle. But then you see a lot of like zeros in there, frankly speaking, from these strategies, simply because they're very different, right? And if you can't fill it, then why is the manager not filling it, right? I think VC is a little different. I think in terms of the hot deal and sort of what's going on in AI, deals can get filled very quickly, but then it's still a balancing act for the GP. On the Revere side, we actually rate for LP co-investments. So a lot of LPs I know in the family office world are purely using emerging managers as a conduit to expand their network, whether it's in Southeast Asia, Silicon Valley, Europe, et cetera, right? And the emerging manager oftentimes has to play ball because they're bigger LP checks. But they're basically using that to set up their own vehicle to go and do their own investments later on. And LP co-investments are a critical part of that. We tell the LPs, if the GP is not offering that and we rate it as a red, then you shouldn't be looking at that fund because you're not going to be happy about it. But most GPs, on our view, if you're doing your job right, you're raising X amount of money, you don't have enough money to fill it anyway on your super pro rata and those pro ratas and sort of what you're getting from the company, and you need that LP support. So it's a two-way street, long way of saying, but everyone needs to communicate and sort of know what's going to happen when they can fulfill their obligations.
Yeah, that makes sense. Another one that you talked about, the family office persona being one that, and just understanding what the co-investment appetite is from both sides, how you're going to make it work. Another one that we've seen a lot of in the interest of accessing deal flow are other managers, other funds, other managers. Maybe they're a little bit later stage, more established. Cindy, is that something that you've seen as far as maybe LPs that you're working with, or just an interest in that kind of deal flow access from a manager LP?
Yeah, if I understand correctly, so some of my LPs, they are very clear. They invest because they want to use my fund as a feeder. So when some of my portfolio companies are raising the next round, and then they can, have the first dip, and then you get intro, know more, can back channel, and yeah, their sole purpose is not just the markup, but the TVPI is really deal flow for them to do later rounds.
Yeah, that's an interesting phenomenon. I think, yeah, that's pretty interesting. I think that's good. I think
It is very good because
yeah.
it also works for founders. I know what not to disclose, right? I will never disclose information that won't help the founders. I can say what I really think. I will not say, oh, this company is good if it's not. So I protect both my LP and the founders in a very neutral way. And the founders love that I can introduce to the next round the lead investors from my LP base. And LPs, so it really works for all.
I think, Cindy, that's a great point, because I think when we think about, we find that operator emerging manager GPs add a lot of value in terms of their fund outperformance to their startup companies, right? Because they've been through it before, right? But a close second is the ability to help the companies in their portfolio raise follow-on capital, right? It's an art, it's a skill, it's a science in all three ways, right? Like Cindy mentioned, you have to tell a story, but you have to disclose good things, but obviously sort of there are risks with every investment, right? One. Two, paint sort of, again, I think deal management is sort of very, very important because everyone operates on their own timelines, right? I think three, the ability to get capital to that company, because capital obviously is much scarcer in many ways now than it was in 2019, 2020, is sort of the lifeblood of companies. So I think those three things a good emerging manager will be able to do consistently.
Yeah, that makes sense. Chris, to just kind of close the loop on this structured co-investment opportunity, are you seeing any trends or like median numbers around the economics piece of it? Cindy alluded to it before. Maybe it's like you're offering reduced carry if it's an LP in the fund who is coming in on the syndicated deal. Are there any kind of like standards terms on that?
I think standards are, unfortunately, they vary, because I think a lot of it deals with like the LP's clout. I think if the LP is a bigger investor and or sort of someone name, or they know that if the GP introduces that to the company, there's a signal that that LP is going on the cap table or doing certain things in certain industries. I think they can throw their weight around, right? So they can bring down fees and sort of within that for the greater good of the group, so to speak. I have seen other GPs on the other end of the spectrum who are like, I don't care who they are. They're paying full freight. This is sort of how I run my business, and to each their own, right? That's fine. There's nothing wrong with that as well. But I think in this market, outside of the usual AI deals that are raising pre-seed at like this much money at uncapped notes and stuff like that, everyone is sort of getting along to get along. It's a little different than it was a couple of years ago.
Yeah, and also it's a supply and demand, right? So if it's AI deal, if it's a hard deal, I really don't care if this LP invests or not. I know I can, just raise so much money. But another, it's not standard, but sometimes LPs, let's say it's a personal, it's an individual investor, but he wants to put in 100,000, a quarter million. In a deal, right? So he couldn't directly go to the founder because there's no relationship. However, he really is putting down a lot of money, so he asked for lower carry. Yeah, I would definitely discuss if it makes sense. Why not?
Mm-hmm.
Yeah, that's good perspective. Maybe it's not one size fits all, even on a deal by deal basis or an investor by investor basis. You gotta be flexible and strategic. I guess in the vein of thinking about this, as the types of deals change, I want to talk a little bit about pro rata specifically. So within these co-investment opportunities, for emerging managers, oftentimes portfolio construction with smaller funds becomes really important. How you're thinking about that, and with reserves, specifically. So with respect to pro rata and this idea of maybe using SPVs as a part of your structuring strategy up front to take advantage of pro rata, maybe keep less reserves or no reserves. So that's kind of the idea. And I want to ask you guys, is the macroeconomic environment really significant in how managers are choosing to structure their investments? Is it something that has changed, from 2021 till now, when it comes to how you're thinking about deploying the capital that you're going to deploy? Cindy, I'll start with you.
Okay, so for my fund, because it is strategically smaller on the smaller side, so I don't have a lot of reserve. And also for my personal taste, I like the first check to be the biggest hit. And so I do ask for pro rata. And but again, SPV takes time, right? So if it is a very quick round, I may not be able to raise enough within a short time using the SPV. So then again, that's when if I have LP relationship, so it is really an art. So by default, if managers ask for pro rata, we should always ask for pro rata. But also in reality, how you feel it. How fast can you feel it? Even if you have the paperwork with the pro rata, sometimes you still need to earn it. You may not be able to have it, even if on paper you have it, right? So again, yes, SPV definitely provides an extra channel, but the challenge is how fast you can feel it.
Yeah, I don't have anything to add. I think it's spot on. I think in terms of it's all a balancing act between sort of the three parties involved and how you can move fast, right? I would say from a macroeconomic standpoint, when you think about, finally like Reddit went public, right? Reddit, big news, and hopefully that opens the window for more companies, because a lot of investors, as everyone knows here, are sort of waiting for the proceeds of these companies that have been they've had their money locked up for almost a decade to recycle into sort of new investments, right? And I believe that when during sort of right before COVID into COVID, when we printed a lot of money in terms of putting more money in monetary supply into the system, that went back into sort of early stage investments and sort of all different types of alternatives. But then sort of things kind of slowed down to a halt when the IPO window has closed basically for the last couple of months, if not a year. I think if that opens back up, then the deals that Cindy and other emerging managers are running, there will be more LPs with flush with cash that will reinvest that into the cycle, because it is a cycle. But until that happens, deals may take longer to close if it's not the hottest AI deal. And sort of LPs that normally would be good for 100, 250, $500,000 for these things they're just cash poor right now because they're waiting for the distributions for IPOs and other exits.
Makes sense. Yeah, so that there's certainly the macro factor on the cash availability for these follow-ons, and thinking about portfolio construction. Cindy, it sounds like you're really focused on the initial deployment and putting as much as you can to the concentration around your first check.
Yeah.
What are some of the implications of having reserves, maybe on fund metrics, as well as thinking about the construction more broadly? Chris, how do you, from the Revere side, how do you think about portfolio construction when you're looking at different managers, and like, is reserves and their strategy around reserves something that
thanks. No, it's a good question. Within that 20-point evaluation system, portfolio management and sort of following on is something also that we evaluate, right? Because what we want to do is not because I like Cindy or if I like an emerging manager that they get all good scores. But basically, I want to take Cindy's fund and her track record and what she does in terms of managing things and put that against 500 or so managers that have gone through our ecosystem, and then let the results speak for themselves, right? A sort of benchmark or a standardized scoring system, a la Morningstar for stocks, but for emerging managers. So we do that, right? So when you think about that, we do critique and sort of look at pro rata and follow-ons and sort of how they win the next deal. Because to Cindy's point, a lot of good companies or great companies are like, you have 72 hours to fill it. And if you can't do it, that pro rata is going to Sequoia, who's taking the whole round, right? Or something like that. So when the managers have budgeted for their follow-ons and or have fought for the pro rata or the super pro rata, whatever it is, and then follows on, it is a labor of love. It's a hard task for most emerging managers, right? So if they can do that, they score higher because, again, they are value add, they are acting faster, and they're helping the companies, which at the end of the day boost overall returns. So we do evaluate that, and it's something that is worth watching if you're an LP, if you're evaluating a GP.
Yeah, that makes sense. And I guess more broadly on the thesis and how to categorize and then leverage data on thesis. Coming back, Sydney, it was interesting that you said because you're generalist, you don't have to really worry as much about off thesis investments. And do I syndicate an SPV for a deal because I love the deal? You can do deals that you love out of the fund without any issue. Has that been an important part of your thesis, is to be able to just do the best deals regardless of what they are?
So the best deals regardless of what they are. So how do you define best? Then it comes to the GP's strength, right? So my strength is enterprise software. So even I am generalist, 70% of my portfolio is B2B enterprise software. So I do have off thesis, but my LPs also know that's a minority. That's maybe 5% for frontier, 5% this, So they also know there are things I don't do, like consumers, social network, and gaming, or bio that takes like 15 years for FDA, things like that. I cannot due diligence. And that's not my strength. So yes, my LPs trust me. I will do the best deals. But also the best deals is limited by my strength. So again, it's balancing, right? I can invest in whatever, but if you look at my portfolio, it's not just whatever. There is a pattern. There's a focus. Yeah. And then
what about
very few off thesis. Yeah.
What about stage? How do you think about stage?
Stage, that is very clear. Stage, I tell my LPs it's a pre-seed and a seed focused. But again, once in a while, I may do a Series A. I do have that flexibility, but I won't abuse it. Because again, end of the day, look at a portfolio. Oh, you can tell that's a very small percentage, 1 or 2 times. Because otherwise it's too diversified.
Yeah, that makes sense. Chris, how do you think about on this one?
Yeah. Okay. So if we separate the two, I think there's nothing wrong with being a generalist if you're making money, right? Like if you're crushing it, I think to Cindy's point, most generalists, most generalists, if you're but most generalists do have a specialization or a background that they're really interested in, right? It's kind of how they made their name. I think if you're not jumping into biotech where you're not knowing what you're doing or sort of deep tech and all that, then you can kind of stay away from getting into trouble, so to speak, right? I would say this, though. I think a lot of the managers that are in our ecosystem that we meet have specialized, right? You have supply chain logistics, you have people doing certain types of blockchain, certain types of biotech, industrial synthetic biology, and all this other stuff, right? Because as innovation and sort of companies come out, they're becoming more and more sort of, you need to be a value add unlock for those companies, because a lot of times they have scientists or engineers or people that are not from investing and they don't know how to sort of grow the company past the tech, right? So I would say one. I would also say that for emerging managers listening, a couple of LPs in our network have made really interesting points around kind of when an LP is sizing you up, right? And it's not just a sort of an ultra high net worth or a friend that's investing in another friend. But if you're looking at the sophisticated family offices, the larger endowments, sovereigns, pensions, they have to fit you within a bucket, right? But it's not because they only want you to do certain things. It's more because they're doing models and they're sort of figuring out what you're doing and then doing sort of the analysis on, okay, if you're saying you're pre-seed seed in biotech, we can expect this kind of outcome and this kind of return. But if you stray into Series A and you start doing deep tech, then that kind of messes up their models, right? Because they take every fund for what they are by themselves as a part of a broader portfolio construction exercise. So I think while you go in and you can invest and do whatever you want, if you have a very sort of generalist mandate in LPA, just remember that when you come back to them on fund 2 or fund 3, they're going to remember that, right? They're going to be like, okay, you said that you were doing this, a bunch of Series A's popped up, can you tell us more about that, right? Or they may not re-up for the reasons that I mentioned. So just something to think about. I think as LPs become more sophisticated, and there's just so many good emerging managers out there, that they will become pickier with portfolio construction and asset allocation.
Yeah, that's great. Cindy, which LPs have been the best fit for you, and how have you positioned yourself to them?
So it's similar as when you ask the founders who are your favorite investors.
Yeah.
So I have different LPs. I have most of my LPs. They are hands off, which I like. Meaning I will reach out to them. They don't need to ask me for updates. Usually we give quarterly updates, or if there's a breakout company, or on as needed basis. So our my relationship with LPs are most of them are hands off. I don't even know who they are because I have rolling funds. They just invested without talking to me. But I have developed a closer relationship with some of them, and some of them even has become, I would call him like my life advisor. Basically, it's beyond the fund anymore, right? Because when we run a fund, it's not just the fund. It's everything. Basically, it's what we do is who we are, so I have developed a closer relationship. I don't want to tell out the names. I have a few very like a closer LPs, and one of them even we just text a little bit. I sent my founders to meet him in person. I've never talked to him on phone. It's only text. But I feel he supports me so much. He doubles down, invests in so many quarters, and double down on my portfolio company. So he co-invests. Sometimes we don't even know. That's a great LP, right? I feel wow. So we really align on so many things. But yeah, maybe I should build a closer relationship with more of my LPs. I think as I raise my fund too, that I already formed. I will have fewer LPs. As I have fewer LPs, each one I'd love to spend more time. Also, of course, I want them to invest in my future funds. It's a different LP profile and a different relationship.
Yeah, I would add, this is a people business. I think more so than hedge funds and mutual funds and sort of real estate is what it is. But venture capital, as it is people. You have to know each other, and the ecosystem is actually pretty small and all that, right? I would say that as an LP in my past life, it was the emerging managers that had the time to spend with you to talk about their ideas, right? Because they're always marketing themselves. They have to. They're not a name brand yet, right, so to speak. So, people that we invested in include Amplify LA, Metaprop New York, and these really good fund managers, Tamarisk in Boston. When I fly in and meet them, they would tell me about the ecosystem, like what LA is happening, New York, prop tech, et cetera. They would spend the time, right? Because it's a people business. I will always be sort of grateful for that because it helped me learn about the industry, and they made introductions as an LP, et cetera, et cetera. So I think as emerging managers, when you do that, just remember that the LPs are they have money with you, but they're generally curious because they want to learn, right? That's why they're invested in you. And do take the time. I think do take the time and sort of get to know them, because again, they're sources of capital, they're sources of introductions, and this is sort of a people business through and through.
Yeah, I want to add something. So I think one reason many of my LPs are hands-off because they first learn about me on Twitter. So they follow me on Twitter, and I'm active there. So they feel like they talk to me all the time. Although we don't do that the person just the person to person. So maybe that's why. Yeah.
They feel like they know you. You've developed a relationship. You've established who you are and your personality. I think that is a newer trend, right? That's something like Twitter or social media or some digital media enables LPs to get to know a GP and somewhat of it's a relationship. I think that's a really interesting point around, because I want to come back to you, Chris, on this. This is a relationships thing, but how are people leveraging tech to do that, right? I mean, Revere, if you're an LP and you're trying to familiarize yourself with the emerging manager ecosystem, yes, you want to develop relationships, but like, how do you leverage tech to do that?
Yeah, great question. I think right now, in the past, I always tell the story. In 2017, when I was doing a deeper dive into LA and New York's ecosystems, I would Google, New York VCs and like see like Union Square Ventures, right? Send an email to the inbox, obviously no response, right? Just being naive and sort of new to the industry. I think right now you have all these different platforms that are, sort of discovering emerging managers. Obviously, for Revere, we built the collective in terms of we connect over, the 550 GPs in our network to the thousands of LPs around the world. We don't charge anything. We just want to do events. Angela Shu runs that for us. And basically, essentially, we go to different cities. We're going to Tokyo in basically 2 weeks to host an Emerging Horizons conference there, bringing 10 of our GPs there and meeting with the local ecosystem, right? We do this because it goes back to my point about this being a people relationship business. You got to be out there, right? But when you look at the technology and the data, there are a lot of different managers out there. Our technology is on the LP side. We do portfolio management software for you to track your funds, look at the underlying companies, full drill down, data ingestion, automation. From there, what we want to do is make sure that the LP knows that, Cindy's companies are doing very well. You should go talk to Cindy, right? Go learn more from her. When she raises her fund 3, invest in her fund 3, right? On the GP side, I mentioned the ratings and sort of the data. So to join our collective, GPs submit their information, and we have that on our, to basically then do benchmarking reports, et cetera, so that when LPs want to connect and ask me about who's the best generalist here, who's doing enterprise SaaS, I will have those recommendations ready for them through data. So that's just a little bit of what we do in terms of using data to make right connections. Hopefully people make money together.
Yeah, that's awesome. Cindy, were you intentionally setting out to build an emerging manager brand through Twitter, or did that happen organically, like sort of like unplanned? Because that is such a big part of you have such a brand, and I think in large part it was leveraging this technology and this channel. So I'm curious to get your perspective on that.
It's very, very organic. I started being active on Twitter in 2019. And then I'm like, so of course, I loved seeing people's, the people I admire, their content. And then I started just, tweeting my own thoughts. And then I realized, wow, actually people like it. Even people reach out to me. And back then I had less than 1,000 followers. I gotta say, without my Twitter activity, I wouldn't probably have even thought of raising my own fund. It's really reinforcing. Oh, okay, there is something there. People really appreciate it. People like it. Okay, let me do more. So it's from being very organic to later, I realize, oh, I can be more intentional. But again, if you look at my tweets, I tweet about everything. I don't have a plan. It's really about me. That's why when people meet me in person, they're like, oh, yeah, you're Cindy. Oh, they're like, you're the same, because it is all me. I would say it's both. It's being authentic, organic, but of course I know it has worked, so I want to make it work better. As for how, I'm still figuring out.
No, I think Cindy makes a great point. I think with all the tools, right, like Twitter, you have sort of social media, Substack, Medium, all these different places to talk about your views. There's so many new emerging managers because, again, the sort of gating items and the cost of starting a fund have been driven lower by technology companies like ours, right, Rob? In addition to sort of the ability to outsource things, et cetera, right? So how do you stand out, right? Being your authentic self, talking about different things, adding value to the discussion, not just like throwing rocks and being sort of a jerk, but basically adding sort of, talking about things from your perspective, your unique sort of insight, right? I think that's really important. Now, we in the big sort of run up, especially in blockchain in 2020, 2021, we saw managers selling parts of their GP, their management company, on Twitter, right? Which triggers kind of like securities laws issues. If you think about that, we're probably going back away. We're probably regressing from that mania back in the day and like tokenizing and blockchaining and putting on the blockchain. But again, it goes back to Cindy's point. It's really important to establish your brand, especially if you're not sort of someone from Lightspeed or spin out of Andreessen, et cetera, where you have a brand cachet that comes with you, and basically going out there, sort of talking about why you, right? What is your sort of edge, your unique, sort of value add, and how you're going to go about it. I think that's very important.
Yeah, I think another thing I want to mention is people constantly tell me, oh, I read, I learn about you, wow, it's, so they use a certain word to make me feel, blush. But I think what's different about me is if you look at my resume, I didn't work at the hottest startup, all that. I didn't go to Harvard, but still, in this world, I ventured into VC, or, I've made a mark, I've invested in so many, amazing companies, or you call unicorns. They see that as, wow, if you can do it, or you were outsider, right? So it gives them yeah, I mean, a lot of the founders I am the most proud of is when I invest in them, they were outsiders. They were from another country, immigrants, all that. But then, they are so resourceful, they are so good, and then they become stars, right? I'm most proud of when I in that category. Of course, I'm also proud if I can get into, proven, second, third time founders. I think, so social media is kind of a leveling play ground. So for everybody to have a voice, have opportunity. Yeah.
Yeah, that's great. All right, last thing, if a manager or an LP is trying to connect with this ecosystem and wants to take a look at Revere, Chris, how would they go about getting on?
Just contact us. I check every email. I'm on go through LinkedIn, look at our website, reverevc.com. You can sign up there for the collective. If you're an LP, like we're all, it's free of charge. You get data, you get ideas. Obviously, we want to help you manage your investments, et cetera, through our portfolio management systems. But we're here to help, right? GPs, we know it's tough. Like for a lot of people out there, it's not a great environment, but we're here to help, right? We stop short of raising capital for you, but we'll make the connections. We'll include you. You'll see how you stack rank against sort of our 500 manager plus data. And 3, sort of we have all these other value add things that we're building within the collective, different partnerships, financing situations, different things like that. So just reach out, look at our website, and we're proud to work with people like Sydecar as well as Cindy, and we're here to help.
Cool, thank you. Cindy, someone, maybe a prospective LP that's trying to get in touch with you and develop a relationship, what's the best way to connect?
Well, my email, or the best way is to, follow me on Twitter, reach out to me on Twitter or on LinkedIn. Now I do more and more LinkedIn, which we are doing for this Q&A. So yeah, just follow me on Twitter.
Are you on Threads too?
Are
GPs moving to Threads? I saw like some, I don't know if like everyone uses Threads. I'm too old for, Threads.
Oh, I don't use. Oh, I used it just a little bit when it first started. So my main game is still Twitter, and then sometimes LinkedIn. It's reinforced outreach.
No, I'm too old for TikTok, so I'm not going on TikTok.
Oh, some GPs are so good at TikTok. Yeah. I really applaud them. I wish I could, but maybe in the future.
Yeah, wherever the right audience is. Okay, well, this has been really great. Thank you both for giving us the perspective and the insight, and for sharing it with the community here. Everyone knows how to get in touch. We'll send a follow up here that recaps it as well with ways that the viewers can get in touch. So, thanks for joining, and we'll see you soon.
Thanks,
Thank
Rob.
you so much.
Sydney,
Such a pleasure. Bye-bye.
Yeah.